Predatory practices. The industry was marked by aggressive acquisitions, buyouts, and unethical practices. Market consolidation. CPG anticipated fewer but larger players in the industry, seeing an opportunity for Morgan to expand as regulatory barriers fell. Core earnings focus. Revenue sources were defined and measured across 6 key areas, emphasizing fee income for stability. This was a shift from traditional approaches. Investment and cost management. The plan called for capital expenditures in technology, personnel development, and asset management. Cost containment was crucial as expenses had nearly doubled from 1985 to 1990. Acquisition strategy. CPG considered acquisitions to enhance earnings, focusing on 3 business lines: Securities Trust and Information Services, STIS, JPMorgan Investment Management, JPMIM, and Private Banking, PB. Acquisition targets. State Street Bank and Northern Trust. Both were attractive for their capabilities in global custody, master trust services, and fund management. However, Morgan ultimately did not pursue these acquisitions. Technology investments. Significant investments were planned for upgrading client reporting capabilities and building databases to stay competitive, particularly in global custody. Challenges in security support operations. Gaps in processing and reporting capabilities led to considerations of mergers, joint ventures, or outsourcing to achieve economies of scale. Strategic objectives. The plan aimed for 10% annual growth in core earnings over the next 2 years, with a focus on leveraging mature and profitable businesses. Share price impact. Despite a decline in market capitalization, the plan aimed to boost share price through acquisitions rather than organic growth, reflecting cautious optimism about Morgan's future. Execution uncertainty. While the plan was well conceived, the ultimate success depended on management's ability to execute effectively. Conclusion. The strategic plan anticipated moderate profit growth, cost leveling, and continued premium share price trading, but its success hinged on execution amid a challenging environment. 14. Risk management and derivatives background. In the 1970s to 1980s, financial market volatility led to the development of advanced risk management procedures and derivative instruments. Traditionally, banks focused on customer relationships and qualitative credit risk assessments without systematic risk quantification. RAROC, risk-adjusted return on capital, developed by Bankers Trust, BT, under Charles Sanford in the late 1970s. Concept, allocates capital based on the risk level of each product line, allowing uniform comparison across activities. Impact, transformed BT into a dynamic, well-capitalized wholesale financial institution. JPMorgan's risk management evolution. Dennis Weatherstone's motivation, understanding market fluctuation risks and appropriate capital reserves. 4 to 15 report. 1989, a daily report at 4:15 p.m. quantifying risks across all business lines, focusing on potential daily losses. Value at risk. VAR, developed by JPMorgan's quants to measure potential losses with a 95% confidence interval. VAR's role became a common currency of risk for comparing risks across different business lines. VAR computation, 5 stages, included analysis of treasury yields, yield spreads, yield curve positioning, asset class shifts, and options risks. Result, helped establish trading limits and informed capital allocation decisions. Stephen Theek's contribution. Role, brought in from the New York Fed in 1989 to head JPMorgan's Economic Research Group and oversee risk management. Framework, defined risk as uncertainty in future economic earnings, applied systematically at micro, macro, and strategic levels. 4 to 15 report goals. Transparency, risk quantification, timely information, diversification, independent oversight, and sound judgment in risk management. Risk metrics methodology, 1992 launch, introduced to the market due to growing demand for risk management expertise. Spin-off. In 1998, JPMorgan's corporate risk management department became the Risk Metrics Group, post-long-term capital management crisis. Derivatives development. Origins, traced to the 1970s post-Bretton Woods, addressing currency and interest rate fluctuations. Currency swaps, emerged from the need for long-term currency exposure hedging, evolving into a market by the 1980s. Interest rate swaps began in the euro market in 1981, growing rapidly with increased institutional participation. Morgan swaps business, 1980s, managed by Morgan Guarantee Limited in London, facing leadership changes with the departure of Connie Voldstad in 1988. Peter Hancock, 1990, took over the swaps team, leading its expansion and innovation, eventually managing the fixed income division. Derivatives business growth, 1990s. Morgan's derivatives team, though not pioneers, leveraged the bank's high credit rating to grow the business, contributing significantly to profits. Innovation focus. Peter Hancock pushed the team to continually innovate, resulting in the creation of new derivative products like credit default swaps, CDS. Credit default swaps, CDS concept, created to hedge credit risk by transferring it to other institutions. First CDS, executed with the European Bank for Reconstruction and Development, EBRD, to hedge Exxon's credit risk post-Valdez oil spill. Regulatory approval. CDS recognized by the Federal Reserve in 1996, allowing banks to reduce reserve requirements. Securitization and synthetic CDOs. Expansion. CDS growth led to the development of synthetic collateralized debt obligations, CDOs, pooling loans and segmenting them by risk for investor purchase. Rating agencies. Morgan's team convinced agencies to grant AAA ratings to diversified CDOs. Criticism and challenges. Post-GFC critique. VaR and risk management procedures criticized for contributing to the 2008 global financial crisis. Flaws. VaR's reliance on historical data, normal distribution assumptions, and underestimation of tail risks were significant issues highlighted by critics like Nassim Taleb. Legacy and conservatism. JPMorgan's approach. Despite criticism, JPMorgan's risk management was considered robust, avoiding excessive risk and maintaining a conservative stance. Impact. Superior risk management became a hallmark of JPMorgan, balancing innovation with protection against market and credit risks. Conclusion. Risk management culture, emphasized throughout the institution, with continuous refinement of risk models and a focus on qualitative decision-making. Financial model shift. Transition from traditional lending to securitization, focusing on transaction fees and leveraging capital effectively. 15 strategic challenges assessment. Mid-1994 senior management evaluated Morgan's progress in implementing its strategic plan, revealing a mixed outcome. Morgan's securities businesses were gaining traction post-1990, but lagged behind top competitors like Goldman Sachs, Morgan Stanley, and Merrill Lynch. Securities business development. 1988 to 1993 JPMorgan Securities began seeing significant equity revenue by 1992, reaching $50 billion in 1992 and $82 billion in 1993. Despite growth, Morgan's market share in U.S. equities was under 2%, far behind leaders Merrill Lynch and Goldman Sachs. Resource allocation. 1993 Morgan's global equities team had 356 employees, significantly fewer than Goldman Sachs, which had over 3 times the number of employees. Morgan's sales and trading team was also smaller, with nearly 850 employees at Goldman compared to Morgan's far smaller team. Fixed income area performance. Morgan's fixed income division grew significantly post-1992, with 1993 revenues hitting $236 billion, equaling Salomon Brothers but trailing Goldman Sachs and Merrill Lynch. Market share in U.S. lead-managed issues rose to over 3%, though still ranked 7th overall. Success in secondary trading. Morgan excelled in secondary trading of fixed income, with revenues tripling from 1990 to 1993, reaching $1.6 billion, second only to Merrill Lynch. Private placements and loan syndications. Morgan ranked number 1 in private placements with a 10.7% market share in 1993. It tied for second in loan syndications globally, with an 11% market share. Investment banking revenue surge. 1992 to 1993 investment banking revenues doubled to $550 billion by 1993, with debt and equity financing contributing significantly. Despite growth, Morgan lagged behind Merrill Lynch, Goldman Sachs, and Morgan Stanley, which had higher revenues and better leverage of personnel. Junior analyst deployment disparity. Competitors like Goldman Sachs deployed far more junior analysts relative to top professionals, creating a competitive advantage in leveraging talent. Internal and external challenges. Internally, Morgan faced resistance in building out its high-yield and equity platforms. Externally, competition from top firms remained stiff, with Morgan needing to take market share from firms that had faltered or been absorbed. STEs and securities processing challenges. By mid-1990s, Morgan faced the challenge of upgrading its STEs platform to meet client needs or exiting the business. The planning group identified issues like the need for technology upgrades, market coverage expansion, and process standardization. Asset management and profitability concerns. JPMIM's incremental growth approach left it unprepared for expansion into new markets. The comp structure created short-term ROE incentives that hindered long-term growth, leading to underinvestment in technology and personnel. Strategic plan for 1995 to 1997. JPMM aimed to grow its business to $800 million by 1997, requiring an 8% annual headcount increase and institutionalized training programs. The plan focused on gaining market share in the defined benefits and defined contribution spaces, and expanding overseas offices. Internal tensions. Changes in JPMIM and private banking led to concerns about revenue capture and fee-sharing arrangements. The reorganization risked isolating private banking from the investment process. Management information system issues. Morgan's management information system lacked transparency, leading to distorted cost and revenue allocation among business units. Business units competed for headcount, capital, and bonuses, creating internal tensions. Complexity and governance challenges. As Morgan grew, managing the bank became increasingly complex, with centralized decision-making adding to governance difficulties. Senior management was overstretched and unfamiliar with new markets and instruments, making effective governance challenging. 16. A chance encounter. Morgan's strategic challenges. In the early 1990s, Morgan faced strategic challenges that were not evident to outsiders. The author, who worked at Salomon Brothers, frequently compared Morgan's economic and market research with Salomon's. Departure from Salomon Brothers. The author left Salomon Brothers in 1991 due to a scandal involving Paul Moser, the head of government bond trading, who violated U.S. Treasury rules. Leadership at Salomon was aware but failed to report it, leading to the author's skepticism about Salomon's recovery and his subsequent move to Prudential Insurance as CIO of the Global Bond and Currency Unit. Prudential's strategy and market turmoil. At Prudential, the author initially favored investing in higher-yielding government bonds due to converging global inflation rates and Europe's move towards a common currency. However, the rejection of the Maastricht Treaty by Danish voters in 1992 caused market instability. The author closed positions and adopted a neutral stance, which proved wise when hedge funds, led by George Soros, shorted the British pound and other currencies later that year. Lessons from market experiences. The experience taught the author the importance of flexibility and recognizing market overreactions, which can create buying opportunities. This led to significant outperformance in 1993, adding $100 million to Prudential's bottom line. Challenges in 1994. The bond markets and currencies behaved unexpectedly in 1994, as the U.S. economy recovered and the Federal Reserve raised interest rates. The author noted that many hedge funds quickly sold European bonds, causing challenges in positioning portfolios. This period led the author to question whether he was in the right job, as managing positions under market pressure was not his preference. Reflection on career at Prudential. The author realized he felt like an outsider at Prudential, managing a boutique operation that was not integral to the firm. A diversity training session triggered deeper reflection on whether he belonged in that environment. Chance encounter with John Olds. In August 1994, the author had a chance encounter with John Olds in London, whom he hadn't seen in 11 years. Olds was transitioning to head Morgan's private bank and mentioned he was looking for a global market strategist, leading the author to consider a return to Morgan. Assessment of Morgan's strengths. The author reflected on Morgan's strengths, particularly its global bond research and emerging market indices, which had become industry standards. He noted Morgan's consistent professionalism and integrity in his dealings with them as a client at Prudential. Consideration of the private banking role. The author contemplated the differences between institutional and private banking, realizing that private banking required a different skill set. He dismissed negative stereotypes about private bankers after meeting sophisticated representatives from Swiss banks, recognizing the potential and challenge in this new role. Discussion with John Olds. Olds explained his excitement about transforming Morgan's private bank to cater to the rapidly growing high-net-worth market. He emphasized the need for a client-centric approach and the commitment required from Morgan's senior management to achieve this transformation. Decision to join Morgan. After discussing the role and the strategy with Olds, the author was enthusiastic about the opportunity to return to Morgan and expand his expertise. He likened the role to a shift from being a specialist to a general practitioner, adapting advice to the unique needs of private clients. When offered the position as global market strategist for the private bank, the author quickly accepted, feeling like he was going home again. Part 4. Playing Defense 179W57 returned to Morgan. 1995 rejoined JPMorgan after 11 years. Attended orientation at 23 Wall Street, now relocated to 15 Broad Street. Noted significant changes. The iconic lobby had been converted into a conference center, lacking the former grandeur. Visit to new headquarters, 60 Wall Street impressed by the modern, tall building. Staff size had doubled since the early 1980s. Sales and trading occupied the entire 8th floor, segmented into specialized areas, equities, fixed income, emerging markets, etc. Economics department was focused on keeping sales, trading, and institutional clients informed of global economic news and data. Role at private bank, tasked with ensuring private bank and clients were informed about Morgan's global economic views. Responsibilities included briefing weekly meetings, publishing commentaries, and reconciling divergent views between JPMorgan Securities and Investment Management. Differences between New Morgan and Salomon Brothers. Noticed physical similarities between Morgan and Salomon Brothers, except for Salomon's more impressive trading floor. Morgan's private dining rooms had been replaced by a more casual cafeteria setup. 9 West 57th Street, private bank office thrilled to work in Midtown for the first time. Familiar with the building's architecture and history. Office located on the mezzanine level, with a view of bankers on the first floor. Introduction to SDI, Self-Directed Investors SDI, a new unit within the private bank, offered brokerage services via JPMorgan Securities. SDI allowed clients to choose between discretionary management, self-management, or a combination. Emphasized client protection by ensuring salespeople were salaried, with bonuses based on broad performance, not transaction revenues. Private bank's value proposition. Morgan aimed to optimize client wealth through an integrated approach, drawing on its strengths of objectivity and teamwork. The strategy emphasized a private client-focused approach, integrating products and services to meet high-net-worth clients' needs. Risk management and product vetting. Implemented safeguards to ensure proper vetting of client risk profiles and product suitability, especially for structured products. Recruited Sean Bhattacharya to develop guidelines for credit risk and product development, creating a unique heat map for vetting new products. Collaboration with equity research. Formed a strategy group to manage a recommended list of stocks, providing an additional layer of client protection. Brian Seidman joined the team, complementing global markets analysis with bottom-up stock research. 1995 Market Outlook. Developed cautious market outlook, predicting a soft landing for the U.S. economy and a 10% return for U.S. stocks. Concerned about the potential contagion from the Mexican financial crisis but reassured by Morgan's consistent views. Media interaction. Featured in Businessweek as JPMorgan's global strategist, leading to a reprimand for misattribution but highlighting changes in Morgan's approach to media. Client engagement and events. Participated in client outings and events, using creative approaches, e.g., O.J. Simpson trial analogy, to engage clients on market outlook. Involved in high-profile events, such as a dinner featuring Alan Greenspan, showcasing Morgan's influence. International experience. First overseas trip to Geneva, where European and Middle Eastern clients focused on absolute returns and downside risk. Developed an understanding of different investment approaches in Europe and the Middle East, with hedge funds playing a key role. Radar framework. Learned about the Radar, risk-adjusted absolute returns, framework, used by the Geneva office for assessing downside risk. Committed to regular international travel to enhance client relationships and understanding of global markets. Mid-year economic turnaround. The favorable economic environment by mid-1995, with reduced inflation concerns and a strong dollar policy, led to rallies in stocks and bonds. Morgan's stock performance improved in the latter half of the year, boosting morale. Year-end reflections. The year ended on a high note with strong market performance, reaffirming the decision to return to Morgan. Despite the modest Christmas party, felt content with the career choice and the positive trajectory of the firm. 18 Technology and the New Economy 1. 1996 Investor optimism. Investor confidence persisted into 1996, bolstered by signs that the U.S. economy had achieved a soft landing post-aggressive Fed tightening in 1994. By the second half of 1995, inflationary pressures decreased, leading the Fed to gradually lower interest rates, contributing to significant stock market gains, especially in the Nasdaq, which posted a 40% return in 1995. 2. Morgan's annual MDS meeting. The largest gathering in Morgan's history, with 420 managing directors, MDS, at the Millennium Broadway Hotel in late January, included one-third of attendees from overseas. Sandy Warner, leading the session, reviewed Morgan's 1995 performance and outlined future priorities. 3. Warner's leadership style. Warner implemented a flatter organizational structure, stripping out management layers, pushing responsibility to business heads, and avoiding the appointment of a firm president. His leadership circle included senior advisors and business heads reporting directly to him, indicating a shift from previous hierarchical management. 4. House Arrest Group, a senior management conclave meeting monthly to discuss firm-wide issues. Warner's approach to management involved embracing matrix management and utilizing a global communications network, enabled by the growing use of personal computers and emails. 5. 1995 financial performance. Despite challenges from the 1994 bond market sell-off, Mexican peso crisis, and the collapse of Banco Nacional de Crédito, Morgan's profitability increased in 1995, with net income rising to $6.42 per share. Cost control initiatives, including headcount reductions and business divestitures, contributed to this improvement. 6. Technology cost management. The House Arrest Group discussed controlling Morgan's soaring technology costs, which reached $1 billion in 1995. The firm faced challenges with platform incompatibility and considered outsourcing technology needs. 7. New paradigm. Warner's New Paradigm speech emphasized transforming Morgan into a global financial services provider, continuing the work initiated by Lew Preston. Warner advocated for less hierarchy and greater responsibility among business heads, stressing professionalism over internal politics. 8. U.S. economic outlook. The environment was favorable for U.S. markets, with growth accelerating, inflation declining, and the Fed poised to lower interest rates. Corporate profits were rising as a share of GDP, driven by moderate wage increases and improved productivity. 9. Debate on U.S. productivity growth. Economists debated whether advances in computer technology laid the groundwork for a revival in U.S. productivity growth. The latter half of the 1990s saw a boom in business investment in high-tech equipment and software, contributing to increased labor productivity and overall economic growth. 10. The new economy. By the late 1990s, the term the new economy became popular, describing the shift from heavy industry to a technology-based economy. The Nasdaq outpaced the broader market, with tech stocks leading the charge, creating a divergence between growth stocks and value stocks. 11. IPO boom. The late 1990s saw a surge in IPOs, particularly in tech and dot-com companies. High net worth clients were attracted to IPOs due to the potential for significant first-day returns, despite the risk of subsequent underperformance. Morgan's participation in the IPO boom was relatively limited, with a focus on quality research over deal-making. 12. Morgan's presence on the West Coast. Despite the tech boom, Morgan lacked significant presence in Silicon Valley in the mid-1990s, with limited name recognition compared to competitors like Merrill Lynch and Goldman Sachs. Efforts were made to establish a presence and connect with the growing tech community. 13. Private equity revival. The technology boom spurred a revival in private equity, with a sharp increase in investor commitments and leveraged buyouts, LBOs. Private equity firms became more focused on long-term company development and deployed less leverage compared to the 1980s. 14. Chemical Bank and Chase merger. Chemical Bank's acquisition of Chase Manhattan in 1995, valued at nearly $10 billion, created the largest bank in the U.S. The merger, driven by favorable market conditions, involved significant job cuts and branch closures to realize economies of scale. 15. Bank merger activity. The favorable stock market environment in 1995 to 1996 led to a flurry of bank mergers, raising concerns about market sustainability. Fed Chair Alan Greenspan's comments on irrational exuberance briefly unsettled markets, but they quickly rebounded. 16. Impact of technology on financial markets. The rapid pace of technological advancements in the 1990s, including the internet and telecommunications, significantly influenced financial markets, driving investment and altering traditional business models within the financial services industry. 19. Three-ring circus stock market climate. 1997. The stock market was on the rise in early 1997. However, the mood in the private bank turned negative due to an exodus of highly regarded MBAs. Training program and MBA exodus. David Kelso, from Goldman Sachs, ran a training program for MBAs at the private bank starting in January 1995. The program combined on-the-job experience with late afternoon sessions where hypothetical scenarios were discussed. Senior private bank members also contributed to the sessions, giving MBAs a broad overview of the bank's operations. MBA bonuses in 1996 were a point of contention. Top-rated recruits felt undercompensated compared to what they could earn at other firms like Goldman Sachs. The exodus of MBAs began shortly after they received their bonuses, driven by dissatisfaction with compensation and lack of transparency. Changes in leadership. The departures of key figures John Olds and Susan Bell from the private bank were significant losses. John Olds, a visionary and strategist, understood the potential of the private bank in a growing market of affluent clients. Susan Bell had successfully built the SDI unit from scratch, generating over $100 million in revenues by 1996. Jamie Higgins succeeded Olds, but the role seemed downgraded as he reported to Ramon de Oliveira, head of JPMorgan. Liz Patrick succeeded Susan Bell, but there were concerns about her influence. Concerns about product push. The departure of Susan Bell raised concerns about increased pressure to push products that might not be in clients' best interests. The strategy unit was asked to formulate investment ideas tied to derivatives, like call options and market participation deposits, MPDS. An ill-fated investment in Southeast Asian equity markets in 1997 led to significant losses after the Asian financial crisis erupted. Asian financial crisis, 1997 to 1998. The crisis began with a speculative boom in Southeast Asia, leading to a devaluation of the Thai baht and subsequent financial turmoil across the region. The U.S. stock market remained largely unaffected in 1997, posting strong returns, but the crisis spread to other emerging economies by 1998. Wave of financial consolidations. The late 1990s saw a surge in financial mergers, with the most notable being the Citibank Travelers Group merger in April 1998, creating Citigroup. This merger effectively rendered the Glass-Steagall Act obsolete. Other significant mergers included Morgan Stanley with Dean Witter and Merrill Lynch with Mercury Asset Management. There were concerns that these mergers were driven more by empire building than by efficiency gains. Long-term capital management, LTCM, crisis. LTCM, led by John Merriweather and involving Nobel laureates, was highly leveraged and suffered massive losses as the Asian crisis spread. A consortium of financial institutions, led by Goldman Sachs, Merrill Lynch, and the New York Fed, was assembled to bail out LTCM with a $4 billion investment. The crisis underscored the increasing importance of investment banks in arranging financing for hedge funds. Federal Reserve intervention. The Federal Reserve cut interest rates multiple times in late 1998 to stabilize financial markets. This intervention, known as the Greenspan put, reassured investors and led to a strong stock market rally by the end of the year. Broader economic implications. The ongoing financial turmoil raised concerns about the global economy, with particular worry about the potential spread of the crisis to larger economies in North Asia. The resilience of the U.S. stock market despite these challenges highlighted the disconnect between financial markets and underlying economic vulnerabilities. 20 market frenzy market surge post-LTCM rescue, 1998 to 2000. After the rescue of long-term capital management, LTCM, in 1998, the markets experienced a dramatic surge. The S&P 500 increased by about 50% and the Nasdaq rose by more than 270%, surpassing the 5,000 level by March 2000. Investor optimism fueled by Y2K. Investor enthusiasm was driven by fears surrounding Y2K, prompting businesses to overhaul their software systems to prevent failures as the year 2000 approached. This led to accelerated spending on software and hardware, boosting overall business investment. However, investors mistakenly projected this surge in demand to continue throughout the decade. Upward revisions in economic projections. As the economy rebounded from a brief slowdown in mid-1998, economists and analysts raised their projections for economic growth and corporate profits. By March 2000, earnings growth for S&P 500 companies was projected to increase at a 14% annual rate, nearly triple the U.S. economy's trend growth rate. The S&P 500's price-earnings (PE) multiple rose to 24 times forward earnings, with Nasdaq valuations even higher, especially for dot-com companies lacking profits. Technology and financial sectors leading the rally. The technology sector led the rally, driven by Y2K-related spending. The financial sector, heavily leveraged to the economy, also rebounded strongly after the mid-1998 sell-off. JPMorgan, however, lagged behind its peers due to its limited involvement in financing tech companies and startups. Talent drain at Morgan's Private Bank. Morgan's Private Bank faced a talent drain as top performers, including the New Jersey team led by Phil Delorio, left for higher compensation at Merrill Lynch. Despite this, Ramon de Oliveira successfully negotiated their return by addressing concerns about changes in Morgan's private client business model. Management changes and profitability-focused. Jay Staley was appointed head of the private bank with a mandate to improve profitability without increasing costs. Mary Erdoes was promoted to lead the sales effort, tasked with growing revenues by being proactive with clients. Concerns over Morgan's viability and Manda speculation. As the 1990s saw a significant increase in Manda activity, Morgan's lagging share price made it vulnerable to acquisition. There was speculation among Morgan's staff about potential mergers, particularly with Morgan Stanley or Goldman Sachs. Failed merger discussions with Goldman Sachs. Goldman Sachs approached Morgan about a possible merger in 1999, motivated by the impending repeal of the Glass-Steagall Act. Although initial discussions were positive, negotiations ultimately fell apart due to disagreements over leadership roles and concerns about redundancies. Rising stock market and justifications for high valuations. As the stock market continued to rise, some commentators justified high valuations by pointing to low inflation and interest rates, while others argued that the equity risk premium was too high. Books like Dow 36,000 predicted a fourfold increase in the stock market based on the idea that the equity risk premium should be zero. Irrational exuberance and market bubble concerns. Critics like Professor Robert Shiller argued that the market was in a bubble, driven by irrational exuberance. Despite these warnings, value investors who shorted tech stocks or avoided the trend struggled as the tech boom persisted. Federal Reserve's monetary tightening. The Federal Reserve began tightening monetary policy in mid-1999 due to concerns about an overheating economy. Despite this, some investors believed the Fed's actions to supply excess reserves ahead of Y2K would boost the stock market, although this impact was expected to be short-lived. Morgan's limited role in the tech boom. Morgan largely remained on the sidelines during the tech boom, focusing on its traditional large-cap clients rather than aggressively pursuing opportunities in the technology sector. The big question for Morgan was whether the tech mania would last long enough for them to become more involved before the bubble burst. 21. The Managing Directors 2000 Convocation Annual Gathering. Purpose. The Managing Directors, MDS, convocation at Morgan's annual gathering aimed to brief MDS on the firm's performance and future plans, ensuring alignment across all management levels. The event also served as a platform to discuss key industry developments. 1990s context. Morgan's stock had underperformed compared to competitors like Goldman Sachs, Merrill Lynch, and Morgan Stanley since the mid-1990s. The 2000 meeting was crucial, as senior management, led by Sandy Warner, sought to address competitive challenges and outline a strategic plan to regain leadership. Strategic plan introduction. Warner emphasized that Morgan had excelled in areas like derivatives, foreign exchange, and emerging markets but had failed to become a bulge bracket firm in equities. The new strategic focus was on expanding Morgan's wealth management services to target high net worth, HNW, individuals and the mass affluent, households with less than $1 million in liquid assets but with growth potential. Wealth management opportunity. The HNW market was seen as fragmented and underpenetrated, with significant growth potential, especially as many new millionaires were emerging from tech industries. Merrill Lynch was the market leader, but Morgan aimed to leverage its reputation and research capabilities to close the gap. Financial plan overview. Peter Hancock, Morgan's CFO, presented the financial implications, outlining a three-segment client strategy based on liquid assets. The plan required an investment of $250 to $300 billion over 3 years. Initial reactions were mixed, with many MDS skeptical of the plan's ambitious goals. Technology and talent sessions. The meeting featured sessions on the growing importance of technology, with Todd Kriselman of theglobe.com discussing the Internet's impact, though his presentation was seen as disconnected from Morgan's needs. A session on winning the war for talent emphasized changing expectations of young recruits but was met with similar skepticism. Plan reactions and management response. Despite senior management's efforts, the MD's final votes on the plan were less favorable than initially. Warner expressed frustration with the lack of support, reflecting a growing disconnect between senior management and the broader organization. Private bank perspective. The private bank, a key unit within Morgan, recognized the importance of the new wealth management strategy but had reservations about its execution. The initial rollout of the new services received a lukewarm response, with few new clients signing up. Market challenges. The broader economic context added to Morgan's challenges. The tech bubble burst in early 2000, leading to a significant decline in the Nasdaq index and negatively impacting Morgan's share price. This financial strain compounded internal issues, leading to the cancellation of job offers and contributing to a tense atmosphere. Merger rumors and outcome. By summer 2000, rumors of a potential acquisition circulated, with Deutsche Bank and Chase Manhattan as likely suitors. The merger with Chase was eventually announced in September 2000, valued at $30.9 billion. While the merger aimed to create a financial powerhouse, it led to significant cultural and operational challenges. Post-merger discontent. The integration of Morgan and Chase was fraught with difficulties, with employees on both sides feeling alienated. Morgan's employees resented being absorbed by a less prestigious, more bureaucratic institution, while Chase employees viewed their new colleagues as condescending. Cultural decline and departure. The merger marked a significant decline in Morgan's storied culture, leading many to seek opportunities elsewhere. The mood remained grim amid broader economic downturns, and key executives, including Peter Hancock, left the firm. Personal reflection. The author, disillusioned by the changes at Morgan, eventually accepted an opportunity to lead investments at Western and Southern Financial Group. This move allowed him to reconnect with a corporate culture he admired, marking a positive chapter in his career after the turmoil at Morgan. 22 Why Morgan Matters book theme chronicles the story of Morgan, an iconic financial firm, from its peak as a wholesale bank to its acquisition by a retail-oriented rival in 2000 and its evolution into a financial powerhouse. Morgan's role in history. Morgan played a key role in rescuing other financial institutions, supporting governments, and never required federal assistance even during the 2008 global financial crisis, GFC. Transformation timeline. The transformation began in the mid-1980s to mid-1990s under Lew Preston and Dennis Weatherstone, focusing on investment banking and securities. Jamie Dimon later successfully revived Morgan's legacy, achieving what his predecessors couldn't by integrating diverse cultures and business lines. Merger context. The acquisition of Morgan by Chase was not unique. Most rivals also merged. By 2000, only 3 major U.S. banks remained: JPMorgan Chase, Bank of America, and Citicorp, with Wells Fargo later joining as a result of mega mergers. Only Goldman Sachs and Morgan Stanley remain independent among significant investment banks, now operating under the Fed's umbrella as bank holding companies. Morgan's strategic failures. Morgan's strategy of building investment banking from scratch was seen as time-consuming and costly. The bank missed significant opportunities, such as acquiring State Street in the late 1980s, which could have transformed it into a leader in securities-related activities. Impact of bank consolidation. U.S. banking underwent significant consolidation from the 1980s onward due to deregulation and technological changes. By the early 2000s, the top 4 banks held over 1/3 of banking sector assets, rising above 50% after the GFC. Bank consolidation debate. Post-GFC, debates centered on whether bank consolidation improved or endangered the financial system. The Dodd-Frank Act aimed to reduce financial system risks, but some experts argue the banking industry remains at risk due to increased concentration. Concerns over large banks. Critics argue that large financial conglomerates are difficult to manage, contain conflicts of interest, and contribute to market volatility. Some advocate for breaking up large banks or reinstating regulations like Glass-Steagall, while others believe large banks provide necessary global scale and efficiencies. Challenges for JPMorgan Chase. Under Jamie Dimon, JPMorgan Chase became the largest U.S. bank, combining wholesale and retail banking with investment banking. Dimon's leadership was marked by a strategic vision and strong risk management, positioning JPMorgan as a leader during the GFC. JPMorgan Chase's future. The firm's future post-Diamond remains uncertain, with challenges like cybersecurity and fintech on the horizon. Despite past violations and fines, JPMorgan's strong fundamentals suggest it will remain a top global financial institution, continuing the legacy of JPMorgan. Legacy of JPMorgan. The current institution is vastly different from the one founded by J.P. Morgan, but it has maintained its position as a premier financial institution through adaptation and strong management.